All right, stash is coming back in. I'm feeling good. I got my pencil out to do some drawings for you today. Buckle up. One of the most common things I see is that people will think that they're investing when in reality they're just speculating. And there is nothing inherently wrong with speculating, but if you have goals you're trying to achieve, it's probably not the best path in achieving those goals. This sketch is designed to help you understand the difference between investing and speculating and how you can have a better experience with your money overall. And this all starts with you. So there you are, little smiley face. And I want you to imagine for a second that everything you can invest in fits inside this circle. Now, for the sake of this sketch, we're going to focus on the two main categories of investments. That's equity and fixed income, or more commonly referred to as stocks and bonds. Now, as an individual, you probably have a lot of questions about how much should I save, or am I going to be okay? But what I want you to ask yourself is, where do returns come from? Now, fortunately, there's a group of really smart Nobel Prize winning academics who've been studying this for like 70 years. And what they've found is that there's really three key drivers of returns in the stock market. And that's company size. So small companies tend to outperform large companies over time. It's relative price. So lower relative price companies or value stocks tend to outperform higher relative price growth stocks over time. And profitability. Companies with high profitability tend to outperform companies with low profitability over time. On the bond side, there's really two drivers of return, and that's term, so how long you hold the bond, and credit, which is the quality of the issuer of the bond. Now, as your advisor, these are the exact sources of returns that I'm targeting when building portfolios to help you reach your goals. But whether or not we capture those returns balances on a beam. And your success depends entirely on which side you lean towards. On one side of the spectrum, we have this ideology that says, in order to capture these returns, you need to be able to outguess markets. Basically saying you need to be able to identify where the market's wrong and predict the future in order to build a portfolio of all the stocks that are going to be winners and stay away from all the ones that are going to be losers. And in order to do that, you need to trade a lot. And while we're at it, if we know where all the winners and losers are, you don't care about diversification because you can build the perfect portfolio. So decrease diversification. And lastly, they're totally fine with paying higher fees for predictions and the implementation costs of building these portfolios. On the other side of the spectrum, we have this idea that you need to trust market prices. Remember, markets do a really good job of incorporating information to set fair prices, and you can use those prices to structure portfolios around those drivers of returns. When you're doing that, you want to keep trading low because trading a portfolio is much like rubbing a bar of soap. The more you do it, the less you're going to have. This side also believes that diversification is your friend. This is the shock absorber for your portfolio. So I like to think about if you were on top of a mountain and you had a skateboard or like one of those giant ATVs with shock absorbers. Diversification is the shock absorbers in that case. And lastly, they want to minimize costs as much as possible because costs eat away at net returns and net returns are what you take home. Now, this side of the spectrum is commonly referred to as investing, while the other side is referred to as speculating. And here at Chris Vita, we wholeheartedly believe that the best way to achieve your goals is to lean heavily towards this side of the spectrum. Now, if we go to the other side of the spectrum, even if we do everything right, sometimes it's going to work out for us. But statistically, you're just as likely for it to not work out. And that's exactly what we're trying to avoid. So instead, we want to embrace these time-tested investment principles so that you're not gambling with your future. Now, here's where you come in. If every time there's some sort of market news or event that is stirring up some sort of emotion from you, and you're wanting me to make predictions about how we can protect your portfolio, all we're doing is pushing towards that speculating side of the balance beam, and that's exactly what we want to avoid. Instead, I want to push you towards the investing side of the spectrum because that's where we see the highest probability of success. So in other words, I just want to combine three things. First, it's these true sources of returns in markets. Second, it's working with an advisor, hopefully me, to help you develop a strategy that captures those returns while focusing on your long-term goals. And lastly, it's you being a disciplined long-term investor and staying as far away from speculating as possible. If we do those three things together, we have a very strong chance of having a successful investment experience and helping you achieve the goals that matter most to you and your family. So, are you investing or speculating? Let me know in the comments. Reach out if you need help building a strategy based on true investment principles and not making predictions, and be sure to follow along for more financial insights.